Welcome to our next chapter, that is mutual fund. Now, mutual fund is a very easy chapter. This comes for approximately 9 marks every attempt. It is free marks. Let's get into it. What is a mutual fund? Mutual fund is when I don't know how to invest, you don't know how to invest, and your friend Ramesh doesn't know how to invest. In such a case, all three of us pool our money and give it to someone who knows how to handle the money. That is someone who knows how to invest. So therefore, it is a mutual fund. It is a fund created by mutual money of a lot of people. So therefore, it is a mutual fund. It is managed by a fund manager. Let's understand what all terms are used first of all. So first is your NAV, that is becomes your very important part, that is your net asset value. Net asset value is the value per unit of the portfolio holding. What do we mean by NAV? NAV is the net assets of the scheme. That is basically whenever we all of us have pooled in money, some assets have been purchased, that is some securities, it could be bonds, it could be securities, could be equity shares, could be anything. Okay, so it is the net assets of the scheme divided by number of units outstanding. Whenever you invest into a company, you purchase shares. Whenever you invest into a mutual fund, you get units. Another important part of this units is this units can be in decimal. For example, your shares cannot be in decimal, but units can be in decimal. Okay. Next is your entry and your exit load. Your entry and your exit load. So your exit load is charged at a time of redemption by deducting from NAV. That is, if you leave the fund, some portion will be charged to you, and entry load is also similar when you enter the fund. Now there is a formula. There is a formula as to how do you calculate the rate required for the portfolio to earn. Say for example that I am an investor and I want a proper 12% return. So if I want a 12% return, how much should the fund earn? 12% answer is no, because fund has their own expenses also. This fund manager that is going to manage the fund, he also has his fees. There are some operating fees that they will incur, that is their office expenses, expenditure, analysis, etc. So after all of this, I want that boss 12% should come in my hand. So the question is, how much should the fund earn? So the rate that is the fund is required to earn is equal to 1 upon 1 minus initial expenses. There are some initial expenses, okay, into R1. R1 is your required rate plus your recurring expenses. Got it? Let's see a question. So if it says that the initial expenses of the fund is 6%, annual recurring expenses is 2%, how much should the fund earn to provide a return of 10%? That means the investor wants that was end of the day I should be earning 10%. So therefore we do 1 minus 1 upon 1 minus 0.06, that is 1 minus 1 minus initial expenses. We multiply this by R1, that is our required rate of return of 10%. Then you add 0.02, that is your recurring expenses. So you get 12.64 percentage. So basically the fund will have to earn 12.64 percentage to give you a return of 10%. Clear? Yes. Now let's see the other. What is your trail commission? Trail commission is the amount paid by a mutual fund investor. Mutual fund investor, like people like you and me, someone who does not know how to invest. The amount paid by a mutual fund investor to an advisor each year. What does this advisor do? The advisor reviews the customer holdings and gives them advice from time to time. So it advises them on their investment. Next is your expense ratio. What do we mean by expense ratio? You must have heard that this fund has an expense ratio of 0.69 percentage. This fund has an expense ratio of 1.12%. What do we mean? Expense ratio is percentage of assets spent to run a mutual fund. It does not include brokerage cost. So whatever expenses that you are incurring to run the mutual fund, that is salaries, your rent, your electricity, any advertisement expenses, etc., all of that will be part of your expenses. This divided by the total number of assets will give you your expense ratio. The lower, the better. Next is your side pocketing. What do we mean by side pocketing? Side pocketing means separation of risky or doubtful assets from other investments and cash holdings. So what does the mutual fund do? For example, they have invested into something and one of the share was ILNFS. Now they invested in ILNFS share and that has been falling constantly. So they don't want that boss, my entire fund suffers because of this. Because now no more new people will come otherwise, because you've invested in such a shitty stock. So what do? They will side pocket such shitty investments. That is, that now we will treat these both as separate. Understood? So you've put it in another pocket. So now both of these can be run independently. So therefore, separation of risky or doubtful assets from other investments and cash holdings. If you have 1 kilo of apples and you have one dirty apple, you have one apple which is rotting, it will spoil all other apples. So you separate it away. That is your side pocketing. Next is your tracking error. Tracking error is the deviation of a fund's return from the benchmark return that it is following. This benchmark return could be Nifty, it could be Sensex, could be anything. So sometimes funds only replicate a benchmark. So whatever difference that they are not able to replicate, that is called the tracking error. What is the formula? It is the differential return minus your average of differential returns whole square divided by number of observations minus 1, and then you put this under the root. Basically, if your share, say for not your share, your mutual fund, if your mutual fund return is, say for example, 12%, 10%, 15%, while your market return is 16%, 10%, and 14%. So this differential return you will calculate as 4%, 0%, and 1%. Then this you will square and you will do everything and you will calculate this via the formula. Okay. Now there is one tricky question in mutual fund, so I just thought we should cover that in this itself. So Mr. X on 1st July 2007 invested 10,000 units. Okay, so we know he invested 10,000 units. Face value of 10. Number of units is how much? Number of units is equal to 10,000. Face value 10. Okay. On 31st March 2008, that is the calendar accounting year end, dividend paid by mutual fund was 10%. Okay, perfect. So we have dividend paid, and Mr. X found his annualized yield was 153.33%. Okay, so they've given annualized yield. On 31st March 2009, that is your next year, 20% dividend was given. And on 31st March 2010, Mr. X redeemed all of his balance of 11,296 units. How is this possible? The question says in the start that he purchased 10,000 units, and it says that in 31st March 2010 he sold 11,296 units. Tell me, how has the number of units increased? How? He didn't purchase any. How these have increased is because this dividend, basically what was given, you have to understand this is a hidden adjustment in the question. When they say dividend question, this mutual fund is a dividend reinvestment plan. Basically, whatever dividend you earn gets reinvested into the mutual fund at the NAV on that date. This does not come to you in cash. Therefore, the number of units have increased from 10,000 to 11,296, which means you have received 1,296.11 units as dividend. Understood? This was the tricky part. Rest everything you will manage. Annualized return was 73.52. What are the NAVs for all the years? So yield for 9 months that they've given us 153.33% is annualized yield. So basically, what is your return for 9 months? Basically, if 153 is for 12 months, what is for 9 months? For 9 months, it comes to 115%. So therefore, market value of investment on 31st March 2008 would be 2,15,000. Tell me, is that correct or not? Because my investment was 1 lakh and I have a return of 115%. So therefore, my market value will become 2,15,000. Tell me, is this correct or not? Right? Next, on 31st March 2008, what will be your NAV? On 31st March 2008, your dividend has already been given. Dividend is how much? Dividend is 10%. So your 1 lakh into 10% is nothing but 10,000. So therefore, 2,15,000 minus 10,000 divided by your 10,000 is your number of units. You get your NAV to be 20.50. Okay. Dividend of 10,000 was paid, has been subtracted because now it is no more belonging to the fund. It has been reinvested. Dividends were reinvested by X in the number of units have increased. We already figured that out. So how much were they reinvested? This 10,000 was reinvested at 20.50. So 10,000 divided by 20.50, you got 487.80 more units. So total units that you have is 10,487 units. Dividend as on 31st March 2009. So dividend as on 31st March, have they given us anything? 20% dividend was given. Correct. So 20% dividend on a 10 rupee face value is 2 rupees. You have total 10,487 shares into 2, you will get 20,975. The balance units will be purchased. So you have 11,296.11. That is your ultimate closing units that they had given minus what you already had. So basically 808.31 units were purchased by this dividend, right? So we had a dividend of 20,000 something and we purchased 800 something shares. So basically your NAV that means was 25.95 units. Tell me if this is correct or not, right? So we calculated what was the balance number of units. We know how much dividend we received. So we got to know what is the NAV of on that date. And simple now on 31st March 2010, again they've given you annualized yield as 73.52. So 1 lakh plus 1 into 73.52 into 33 by 12. This is your total month from the beginning. And you divide this by 11296, you will get 26.75 as your NAV. Here, pause the video if you want. I will erase everything so that you understand. And then you finish this chapter via the question bank that we also have on the website. These notes also you can get on the website. All subjects chapters are in 50 pages. And I'll see you in the next one.